Well, good afternoon. A very warm welcome to everyone joining me today. I want to go through a Fed statement that was released back on May 4th called Plans for Reducing the Size of the Federal Reserve's Balance Sheet. Reason I mention this is that we're coming up on the date where there's going to be considerable Fed tightening. So we have had an original, let's just walk through the statement and then we'll move on there to the implications. So on May 4th, the Fed released, consistent with the principles for reducing the size of the Federal Reserve's balance sheet that were issued in January 2022, all committee participants agreed to the following plans for significantly reducing the Federal Reserve's securities holdings. The committee intends to reduce the Federal Reserve's securities holdings over time in a predictable manner, primarily by adjusting the amounts reinvested of principal payments received from securities held in the System Open Market Account, or SOMA. Beginning on June 1st, principal payments from securities held in SOMA will be reinvested to the extent that they exceed monthly caps. For Treasury Securities, the cap will initially be set at $30 billion a month, and after 3 months will increase to $60 billion per month. The decline in holdings of Treasury securities under this monthly cap will include Treasury coupon securities, and to the extent that coupon maturities are less than the monthly cap, Treasury bills. For agency debt and agency mortgage-backed securities, the cap will initially be set at $17.5 billion per month, and after 3 months will increase to $35 billion per month. Over time, the committee intends to maintain securities holdings in the amounts needed to implement monetary policy efficiently and effectively in its ample reserves regime. To ensure a smooth transition, the committee intends to slow and then stop the decline in the size of the balance sheet when reserve balances are somewhat above the level it judges to be consistent with ample reserves. Once balance sheet runoff has ceased, reserve balances will likely continue to decline for a time, reflecting growth in other Federal Reserve liabilities until the committee judges that reserve balances are at an ample level. Thereafter, the committee will manage security holdings as needed to maintain ample reserves over time. The committee is prepared to adjust any details of its approach to reducing the size of the balance sheet in light of economic and financial developments. Okay, so I've taken the ideas from that press release from May 4th and sort of simplified them so we can kind of follow the bouncing ball, if you will, and put them onto this little PowerPoint slide. So the key aspects of the Fed May 4th press release: beginning on June 1st, principal payments from securities held in the open market account will be reinvested to the extent that they exceed monthly caps. For Treasury securities, this means for June, July, and August of 2022, the cap will be set at $30 billion per month. For September 2022 and beyond, the cap will increase to $60 billion per month. The decline in the holdings of Treasury securities under this monthly cap will include Treasury coupon securities and, to the extent that coupon maturities are less than the monthly cap, Treasury bills. And then for agency debt and mortgage-backed securities, for June, July, and August of 2022, the cap will initially be set at $17.5 billion per month, and for September 2022 and beyond, the cap will increase to $35 billion a month. So let's explore that quite a bit closer, get into the weeds. And in order to do that, we're going to jump over from the main Fed website, over to the New York Federal Reserve website. So let's jump over to the New York Federal Reserve website right now. Okay, so we've jumped over to the New York Fed website, and we're going to go under the hood and take a look at the system open market account holdings of domestic securities. And just to get an idea of the size and the scope of the holdings of the Federal Reserve, as of July 27, 2022, the Federal Reserve, I'm not going to go through each category, but the Federal Reserve had $4.9 trillion in Treasury notes and bonds. And they also had, in terms of agency-backed securities, mortgage-backed securities, $2.7 trillion in mortgage-backed securities. So, and then finally, if you take a look at the very bottom number, total SOMA holdings, $8.3 trillion, $8.360 trillion. And so that's what we're working with. And you can see at the very bottom, the runoff has actually begun, as the change from the prior week is down $8.82 billion, almost $9 billion runoff. So that's a starting point from where we're at right now. And here we have a chart on the New York Fed website that gives you an idea of how the domestic security holdings have grown over the years, starting from 2003 all the way through July 27, 2022. And we can see the growth over time. And the big increase in the Fed balance sheet coming from September, well, really from March 2020, and this explosion through COVID. And now a little bit of runoff in approximately the last 3 months. So that gives you just sort of some background information. And really important is the maturity profile of Treasury securities, because generally speaking, the Fed's not going to be touching Treasury bills. They're going to be touching the longer dated securities, and most of the stuff that the Fed is going to be siphoning off, from what I have read, and we'll get to that, are the 20-year terms. So anyway, here's where we're at, and this is a history. We're going to go through this real quick, but you can see through time and where we're at today. We've got a distribution of greater than 10 years. Let's back that up a little bit. Greater than 10 years, we have $1.4 trillion. Between 5 and 10 years, we have $993 billion. Between 3 and 5 years, $745 billion. And between 1 year and 3 years, we have $1.2 trillion. Now, this is the maturity profile of Treasury securities. So graphically, it looks like what's about to happen is that the Fed is pulling back their balance sheet until approximately 2027, and they're going to reduce assets down to approximately $5 trillion from the current $8.9 trillion. And this is just a quick graphic of what that looks like. So in conclusion, we can see that the roll-off has just begun, and to expect significantly more headwinds going forward for the next 5 years until the Fed reverses course. So for those reasons, we do think that we are going to enter a very difficult period of time for the U.S. stock market, as well as higher interest rates for U.S. bonds looking forward. Thank you very much for joining me. We will talk to you again soon.